You're listening to the Infinite Banking Mastery Podcast. Did you know that you could build a tax-free pool of wealth that's liquid and accessible all your life while building your retirement nest egg? Gain full control of your financial future and stop relying on the government and banks. The wealthy have already discovered this wealth-building secret. Now it's your turn to get financially secure without following the conventional wisdom that keeps you in debt to banks. Now here's your host, Valerie LaRocque.
Hello, everybody. Welcome back to the podcast. I hope y'all had an excellent week as summer winds down here. Today's topic, can I pull income in retirement from my IBC plan? Well, yes, you absolutely can. And I'm sure a lot of you, that's part of the reason you're excited about IBC and you think it's awesome because you can build this pool of cash, use it all your life, be in absolute control of your financing from that pool of cash, do whatever you like and pay yourself back however you like, even though we do have a suggestion for how best to pay yourself back. So a lot of people are excited about being able to use and access this cash income tax free in retirement. This is just another huge win for IBC. Of course, you can't access funds from any whole life policy in your retirement years or just throughout your lifetime. It does not have to be policies specifically structured for the infinite banking concept. All whole life policies will build cash value that you can borrow against at any time of your life. So you don't need to have it actually structured for IBC the way we IBC practitioners are structuring the policy. It's just not going to be as cash efficient like the policies that we are structuring in this particular way. If you build a policy, a whole life policy that's structured in the more plain vanilla or traditional type of way, it will grow cash over time and it will probably have a decent amount of cash in your older years. But in those beginning years, it will have less cash than a policy that's structured for the infinite banking concept. In fact, maybe I should say that in the long run, it's likely to have more cash than a policy structured for infinite banking. And that would be because you've paid more in, because you don't have this paid-up additions rider that eventually has to drop off. You're going to end up paying more into the contract, so you're going to have more cash in the long run. But in the beginning, it's not going to be as efficient. It's not going to build cash as quickly as one structured for the infinite banking concept. So the reason you don't have a lot of cash or cash efficiency or a greater pool of cash in those beginning years when you're building a policy that's just your traditional style, plain vanilla type of structure is because those premiums are, all of that premium is going to support the full death benefit. So whatever that premium amount is, that is the cost of the death benefit that you started with. And so that's why, for example, in year one, you will have close to no dollars available in cash value if you're building it in this other more traditional way. When you're building in that type of structure, your whole life policy is being built with the exact amount of premium needed to support the death benefit. Whereas when we're structuring for the infinite banking concept, we are shoving more cash into the policy over and above the cost of the insurance, over and above the cost of the death benefit. And this is what causes your cash value to grow so much more efficiently because you're putting cash in that is not going to the cost of the death benefit, and it just is able to sit in your account and now build earnings and build dividends on that amount rather than it being swept away for the cost of the death benefit. Because, of course, any sort of thing you do to save cash or invest, there's going to be a cost for it, a financial advisor fee, expense ratios for investments. If you're buying property, of course, there's costs involved with that. So when you're able to put in cash over and above the cost of the insurance, that's part of the cool factor is that that chunk of money is not having fees pulled out of it. Not financial advisor fees, not life insurance fees. Now, I will say that there are contracts in certain companies that do charge a fee for the paid-up additions, or they charge a fee if you put a certain amount of paid-up additions over and above a certain amount that they allow to be free and clear of fees. But having no fee draining off of that is what also helps to fuel your cash forward and to help build your cash. We IBC practitioners are building it in such a way that it is more efficient for your cash value rather than building a large or paying for a higher death benefit. Now, of course, we always want to make sure you have an appropriate amount of death benefit to care for your family or whatever needs you have, whether it's a business partner, a business, your family. We always want to make sure you have an appropriate amount of death benefit to protect those you love or those needs that you have. But in general, we are shrinking it down for this concept. So we might utilize some term insurance to help boost up the total coverage so that you have the appropriate amount of coverage for your needs, your goals, your concerns, and to protect those that you need to protect, to leave a legacy, and to make sure that those who are depending on your income will be taken care of. I've pointed out before in a previous podcast that I feel this traditional style whole life policy is what Dave Ramsey is referring to when he annoyingly states that whole life is a terrible savings vehicle and he gets all riled up. Though I do believe he simply has been firm in his stance for so long that it would make him look bad to change his stance and suddenly be pro whole life. I don't see that happening because then he would have to say that everything he's believed in and stood behind for all these years has been wrong. And I just don't see him doing that. And so because of that, I don't see him bothering to really learn and understand, to really get the truth out there. His whole stance has been to buy term and invest the difference. So I don't expect him to change his stance on that anytime soon. I just like to point out that if you were to compare a traditional style whole life policy structured in that plain vanilla way, which is solving for death benefit, you compare that with a whole life policy structured for the infinite banking concept by a knowledgeable IBC advisor, you will quickly see the difference because the policy structured for the infinite banking concept will have more cash available in those beginning years. And especially in year one, you will see a significant difference in year one because the plain vanilla style will have no cash and the IBC style will have a good amount of cash that you can access right away. But then again, like I mentioned in the beginning of this podcast, the traditional style is likely to have more cash. If you compare them side by side and with the same starting premium amount, the one built for in a more traditional way will have more cash at retirement time because you've paid a lot more in. Whereas with the IBC style policy, again, you're going to have to drop off that paid up additions rider at some point, or the contract will become a modified endowment contract and will be taxable, and you do not want that. So you'll have to drop that off at some point, and then you're going to be paying in less cash. Now, it's going to be growing much more efficiently than the traditional style, but it will have less cash over time. And it will have especially less cash if you really, really squeeze down that base premium. Like I know there's a lot of people out there talking about making that base premium teeny tiny and putting a huge paid up additions rider on top. Once that fuel in the beginning, your paid up additions rider drops off, your only fuel is the base premium. So you do not want it super tiny because that's what's going to be fueling your contract going forward once that paid up additions rider drops off. So there is a balance. You want it to have a good balance so that you have that fuel in the beginning and you can really get going and start using your account for the things you want to buy, purchase, or invest in, or pay off debts. But you also want to have a decent base premium going forward once that paid up additions rider drops off, especially because you're going to want to keep building that account for your retirement years. You're going to want it to be able to build up a good amount of cash so you have a good amount of cash value by the time you hit retirement. And so a lot of people who are into this concept and really excited and they want to have this huge paid up additions rider and squish down the base, and they're just excited about building it as cash heavy as they possibly can, that might restrict you from being able to grow your policy or your whole banking system over time because it's going to cause the structure of the policy, or because of the structure of the policy, which I'd be happy to get in with you more on one-on-one, is going to be restrictive if you are shoving a whole lot of cash over and above the base premium. And then you're not going to be able to grow your overall system. You're going to have to drop off that paid up additions rider at some point, and then you're going to have this teeny tiny base premium. So you want to make sure that there's a good balance when your policy is being structured so that it is building a good amount of cash value for your future. At the end of the day, of course, it's most important that a policy or a life insurance plan be structured to meet and to fit each individual's short-term and long-term needs. You can start with a goal in mind for how much cash you'd like to have in the future, or just kind of do whatever you can and start off with whatever you can when you're starting your policy. And we can project what that would do for you in that one policy, and then maybe do some planning around maybe in a year or so, or in the future, we'll open up a second policy, one on my spouse, one on my children. Once you do reach the year that you want to retire, you will have the option of stopping your premiums at that time. Although one of the contracts that I've been working with lately, it automatically stops premium at age 75 or 25 years, whichever is longer. And so you can continue with that and just let it stop at age 75. Most whole life contracts actually expect you to continue funding your whole life, or basically to age 98. But you also have the opportunity with any whole life contract to stop the premium sooner. I know there's 10 pays out there, 20 pays. I haven't really used 10 pay because it doesn't look as efficient as a different style of contract that I've used, but that is an option. But with any whole life contract, you can also stop the premium sooner. You just want to be careful that it's not going to mech. So there's a certain amount of years you want to keep it in force at a minimum before stopping all premiums, because then the contract could mech. Now, once you're ready to start pulling funds from your cash value account in your retirement years, a plan can be put in place that will allow you to be able to extract funds from the policy without having to pay it back. Because remember, all of your life, we're encouraging you that every loan you take to pay it back, pay yourself back with interest, and more interest than the company is charging you, so that you're building your overall system. But once you reach retirement, we expect that you're not going to be able to, you're not going to want to pay those funds back when you're taking out loans. So there's a certain structure and way to pull those funds out so that you do not have to pay them back. If you have more than one policy, then we can have a plan of how we're going to pull that out. We can create a plan of how best to pull those funds out in a manner that will best work for you. Numbers can be drafted from the company at that future time to show how much cash can be safely withdrawn or borrowed against the policy in those future years. You could choose to take funds for 10 years, 15 years, 20 years. We could get that illustrated out so that we can see the different amounts of cash that you could pull from the policy without causing it to lapse or mech. So clearly, if you did it for a shorter time frame, you'd have access to more dollars over that 10 years. If you want to stretch it out, you think you might live till 90 or something, you can stretch it out as long as you feel you need to. We are just always checking in with the company to make sure that we pull the funds out in such a way that the death benefit remains intact and that you do not have a lapse, that you do not mech the policy. So you can choose to pull funds over a set amount of years that we predetermine, or that is predetermined when you're ready to do it, or you can leave the cash there and have access to it when needed and just take lump sums of cash whenever it's needed throughout your retirement years. If at that time you have retirement accounts that you plan to pull from and live off of primarily or in conjunction with, maybe by the time you hit your retirement years, you didn't get an opportunity to build your cash value as large as you would have liked to. So you're going to be depending a lot on those retirement accounts. It is super convenient. It's super wonderful to have a whole life policy with cash value built that you can access if you're leaning on or depending on or getting most of your income from a retirement account, because in any down market year, that's a year you don't want to have to pull from your market account, because that just compounds the losses. So if it's a down year and you're needing income and you have this cash value account, and maybe you're not able to pull a huge sum of it for your retirement, but you do have a decent amount of cash in there, you could pull your income from that whole life policy instead of your retirement account in any down year to help keep your retirement account from getting lower and having compounded losses. That's a really great way that the whole life account can be leaned on as well, if that's not the place you're planning to get the bulk of your retirement income from, or to pull those dollars as needed in your retirement years. It's great to have one anyway, even if you're a big believer in retirement accounts and that's where the majority of your assets lie. In any down year, you don't want to have to pull from that account, those retirement accounts, because it just makes those losses were. So at least you have a whole life account that you can pull cash from. It works really great. One thing you want to keep in mind as you approach those years and you're starting to think about pulling funds out for your retirement after you've been building this account for so long is that you don't want your account to zero out at any time. You don't want the policy to lapse. So that's why there has to be a plan, or it's a good idea to have a plan in place when you're ready to pull regular amounts of income from it or cash from your policy. You just want to make sure it's not going to lapse, because if it did lapse, then you would owe tax on any gains. And I'm sure in your old age, you are not looking to have Uncle Sam come knocking on your door for a big fat check. No. On another note, if you are about to retire or are nearing retirement and looking for ways to create an income stream soon or now, or if you're 10 years away from retiring and you're wanting to set up or look for ways that you're going to be able to live off of an income stream that you cannot outlive, this is something else I'm able to help you with as well. Or if you're feeling it's time to put an IBC plan in place for you, I would be happy to work with you and help you. You can go ahead and just reach out to me directly at Valerie at alphaomegawealth.com. I hope this episode was helpful to you. Thank you for listening. Have a great week.
This is thepodcastfactory.com.